Hello, everybody. My name is Jackson Pineau. I am your Director of Public Affairs, and I'm going to be giving you a brief presentation about the Minneapolis area realtors, the whole Twin Cities housing market update here for the month of March. I am part of a team. Both myself and Gavin are your research duo here at MAR. Uh, Gavin is not with us here today, but he is the man behind a lot of these charts. So I want to make sure that he knows that we appreciate the work that he's contributing here at MAR, so you guys can appreciate his contributions as well. So for the next 45 minutes or so, I want to walk us through um, a short outline and goals of what we want to attain in that 45-minute time, right? We have some recent showings trends that I want to provide you over the last week, some Twin Cities housing market charts, the ones you know and love. Talk about a little bit about affordability and what's going on in terms of homeowners insurance, and then a quick peek at the larger economy. The goals here for you, we want to make sure that you are an informed individual and you can share these insights not only with your colleagues in real estate, but also with your clients. So, let's jump right into the recent trends showing activity here. This information is all coming from our good friends over at Showing Time. We cobble together the information and share this with you as often as we can, usually by way of our weekly pulse. It is sent to your emails every Monday morning, Monday afternoon, including this data here around showing activity. So, daily showing trends 2025 in black, the one that is not nearly completed yet. Next to in navy blue, 2024 daily showing activity. And you can see we're generally at the same pace in terms of daily showing activity. The most notable trend for the first quarter of the year so far is that we didn't see a big lull in March, April, namely because of the shift in Easter, the Easter holiday. We haven't experienced that yet, so we haven't seen that dip yet, right? But compared to the 5 year average over in that kind of lighter blue, we are noticeably down in terms of showing activity, something to keep in mind as we roll through here. Showing activity by price range here, you can see we're about 2% up compared to where we were this time last year. This is comparing mid-April to mid-April. Here in gray, this is 2025. Navy blue is the same week last year. And you can see generally the trend that we have seen when divided by price range has gone unchanged, right? We have a consistent increase from our market rate up, just about 3-4% up at about the median priced home, the three to $400,000 range, and that is consistent across the board as we increase into the higher price ranges. And in the more affordable market, the $250,000 and below, there are fewer showings. That is a trend we have noticed over the past couple of years, something you might be seeing in your own practice as well. Okay, we know there's a big connection here between interest rates and showing activity. And there's a lot of information on the screen. Let's just keep it pretty simple here and say that the green line here is your interest rate for your 30-year fixed rate mortgage, right? And then in the black, navy blue-ish, that is a year-over-year change in showing activity. And what this is really showing you is that when the interest rates drop, even just a little bit below 7% right now, we see a notable uptick in showing activity. And in the far right, you can see we started to see a slight increase in interest rates and a inverse relationship, a decrease in that showing activity. something to keep in mind around that relationship, around 6.5, 7%. That seems to be the point where buyer behavior is impacted, right? We start seeing more or less showing activity when we see a noticeable drop like that. Let's zoom out a little bit more and take a look at the local housing market, comparing March to March, because that is the most recently completed month of the year. But let's also take a look at the full quarter in a new way, the seasonal reference point. If you were part of our summit just last week, the MAR summit, we released these new charts, and I want to show them here to the broader digital audience as well. So, Twin Cities, oh, let's pop back here. Twin Cities closed sales in March, comparing March of 25 to the year prior, still March, all the way back to 2018. So each of these bars are the month of March in their respective years. And you can see we ended March with about 3,200 homes on the market. It's down just a little bit from where we were this time last year. And you can see for the past 3 years, we've kind of hit a point of stability. After going down almost 20% from 2022, we've gotten into an equilibrium of March ending with about 3,300 homes closed in that month. Now, we do know that there's a seasonal upswing, right? There's going to be more homes that are closed in the summer months than on the winter months, and we call that a seasonal curve, right? That green line is showing us that change, that curve in activity. The new charts that I want to introduce to you that I think are going to become a standard here for these quarterly presentations is talking about a single quarter, but giving you so much information. Visually, a lot is going on here, right? We're trying to answer the question, how's the housing market? And you can see visually the same information still applies. 3,200 homes in the far right navy blue bar is how many homes sold in March. You can now see how many homes sold in February in that middle blue bar, navy blue, and then in January with the leftmost navy blue bar. And paired with each of them is the bar showing you the previous year, 2024 of March, February, January. You can visually see that we're a little bit down 1% from March of 24 to March of 25. We're about 10% down from February of 24 to February of 25. And we're a little bit up from January of 24 to January of 25, right? That visual relationship that you're seeing in the bar charts is helpful, right? But even more helpful is looking at that 10-year average in that lime green line chart to give you a reference point, not only saying we're up or down from this time last year, but we are across the board down in terms of closed sales for the entire first quarter of this year, January, February, and March. And in March, we normally see an uptick from February to March. And we saw that here as well. You can see the navy blue bar in February is noticeably below the 3,200 that we see for March, but we're not quite keeping pace with the seasonal upswing that we normally see in March, because that would mean we'd be up at about where the green line is at about, let's say, 3,700 homes closed in March. And we're just not there, right? So, next time someone asks you, how's the housing market? You can understand it in many different levels compared to last month, compared to this time last year, compared to the 10-year average, right? And all of those reference points are shown here. This will be the only time I'll walk through every single step of this new chart just to introduce this to you all. But we're going to be seeing similar charts like this as we continue through this section of the presentation. So let's flip to the other side talking about new listings, right? So in terms of new listings, we are about 6,000 homes that were listed on the market in March. That's up 12% from March of last year. And again, second year in a row, up from a dip that it was experienced in 2023, right? Around a point of equilibrium, I would say, but we're not quite there yet. You can see prior to the pandemic, 2018 and 2019 as an indicator for you, we had about, let's say, 65 homes that were sold on the market, right? Um, and we're not quite there yet. So let's take a look at that seasonal chart now, and you can see it's showing at a more granular level a little bit more detailed of a picture. Now, yes, seasonal upswing has started to occur, right? More homes sold in March than in February, and you see that 12% increase from March of last year to March of this year, right? We're still noticeably undersupplied in a 10-year average context. So, over the span of the past decade, on average, there have been more homes that have been listed in the month of March. Uh, the same can be said for February, but for January, we actually exceeded that 10-year average. Very interesting, right? We had a more mild winter in terms of both weather and in terms of market performance. It didn't go down as low in market performance as we normally would see, which was impressive in its own way, right? You can see that as the tail ends in January, right? But as we're getting into the spring market, we aren't blooming to allow for the imagery, right, as we normally would be in March. And I would imagine similar trends going to happen if we look at this chart again in April. So, sales and listings, some takeaways for you to help you understand the relationship between you and your clients, whether it's buyers or sellers, right? For buyers, there's less competition for now. We saw that in the demand chart, right? That flat equilibrium, there is less competition, but for now, there will be a return to a higher equilibrium at some point. It will probably be slower, but keep that in mind that there's comparatively less competition than there was 2, 3 years ago. At the same time, there's an increase in supply of listings, right? That's an ideal mix of supply and demand. So watch those mortgage rates, like what we were talking about in the showing activity, because that is going to be a great indicator for you of how much competition your buyers are experiencing now. Not last month, but now. Seller side, yes, demand has softened. But there is that point of buyer stability that you can rely on, right? Now, in the same way that I'm saying that your sellers can rely on that buyer stability, right? And there is indicators that people are believing that because we are seeing a reasonable increase to supply, not a dramatic, oh, I want to get out of the market, but one that is returning back to a normal level of activity. So believe in the buyer stability, right? The sellers, if you're working with sellers, they will need that additional support from you as well because contexts have shifted now, right? This isn't 2021, 2022, and we need to make sure that we are bringing sellers through that journey because there are new expectations now. We'll see that as we talk about pricing, negotiations, and the pace of the market. Speaking of which, median sales price. Yes, median sales price ended in March at $380,000, up 3.5% from March of last year. And, last year we started having that conversation of will the Twin Cities finally break the $400,000 median sales price mark? I'm not sure. I think it will happen, if not this year, next year. But we're right on that edge to start having a conversation around median sales price breaching the 300,000s here in the Twin Cities metro. And this is an indicator for me that we are on the path to do that. You can see 2021 and 2022, we saw noticeable increases. 2023 and 2024, that increase curved, but we are now slightly increasing just a little bit more from 24 to 25. What does that look like when we're looking at a seasonal price here? We got rid of the green line, but instead we're using green tick marks. It's a little bit more clear here for you. Out of a 20-year average, we have 3.5% year over year growth. And if we are exceeding that 20-year average in any given month in terms of price, uh, the blue bars, the dark blue, navy blue bars, are going to exceed the green tick marks that are there. Where if we don't reach a 3.5% growth year over year, the tick mark will be higher than the blue bars. In this case, it looks like for March, we're right on target, 3.5% increase. For February, we exceeded that as a 6% increase. And for January, we exceeded as well a 5% increase from one year to another for each of those respective months. And you can see the seasonal nature of price stability. It doesn't really exist in the same way it does for the countable numbers, sales, and listings, right? That stability should forever be just slightly increasing, and it is, right? That's the main goal here. We want stable, reliable price growth. That is the definition of wealth building here in this industry, and we're seeing that happen right here. So, good signs for price growth. We're on a course for that stability to continue. Now let's talk about negotiations. The average percent of list price received. What percent of the original list pricing did you get at closing? Uh, at on an average here, right? There are three distinct worlds. The pre-pandemic world of negotiation on the left, those two middle bars where the world just didn't see negotiations. It was more about multiple offers. What percent over listing price are you going to offer, right? And now we are returning back to a world of negotiation. About 99% on average is what somebody is getting at closing compared to their listing, right? That's up just a little bit from where we were this time last year. Let's take a look at a seasonal chart because, again, this is a little bit more attuned to seasonality. Negotiations do tend to happen a little bit more in the winter. You can see that by all of these bars, whether they're teal, navy blue, or the green line, right? The winter months are the months more for negotiation on average. And yes, we are below the 10-year average here in all the navy blue bars, but we are so consistently close to all of them that I don't want to give you the picture that there's a meaningfully different type of negotiation world in March just because it happens to be nominally below that line. We're talking about a difference between 95 and 99% and 99.2% on average. There isn't much of a difference there. I think it's more likely to say we're consistent in our negotiation climate than where we have been for the past 10 years. Keep that in mind. We are no longer in this world of 2021 and 2022. We are back to a world that is more typical with what we see in the context of negotiations, right? So, prices and negotiation. What does that mean for your buyers? Yes, price growth has slowed, and that was intentional. We wanted to combat the run on inflation that was happening in 21 and 22, and we saw that price growth slow because of it, right? And sunny side, negotiations are back. But please don't wait to buy just because you are seeing those increased prices, right? There's an intentionality around the slight, consistent, stable increase in prices. And if you can't afford to buy, right? We are in a type of market where not everybody in the world can buy a home, right? Some people have to be set up on a plan to buy homes, right? And if you feel like the time is right for you, please don't wait if you can afford to do so right now, right? Sellers, negotiations are back, right? Same words, different context. Yes, negotiations are back, and frankly, the world that we were in prior is an anomaly, right? This is kind of more the status quo. Set those contexts, set those expectations about price and offers early, because like I am writing here and what I said in the slide before, those agreements match a 20-year average, and that is the world that we are living in. But hey, those prices are being consistent. So good on you for being a homeowner. You are gaining that wealth building practice that is so successful for so many people, right? Cumulative days on market, let's talk about pace here. And you can see almost an inverse relationship where pre-pandemic we had a equilibrium of the pace of the market of around, let's say, mid 20s. Half of all homes sold in and under 20 days, and half of them did not. And then with increased demand, increase overbidding, median cumulative days on markets were cut in half. The speed of the market just sped up, and we returned back to an equilibrium in 23 that has roughly continued since then, of around half of all homes sold with 26 or fewer days on market, right? Now, what does this look like from a seasonal context? You can see think of it, the lower the bars are, the faster the market. It's the reverse of what we were seeing in all the other bars where higher was better, right? Lower is in some ways better here, right? And you can see for January, we had a slightly slower market, right? More sales, more listings, but people were taking a longer time to decide, right? And then in February, same situation. Isn't it interesting now with this new visualization here with the seasonal uptick? And yes, we normally see homes sell faster in March and April than we do in February and January, right? But we're now finally below that 10-year average. Sorry for the teams pop-ins. I just realized they are happening for you as well as for me right now. So, um, March, yes, we had a slightly slower market than March of 2024, up 1 day at the median, but we're right about consistent and just maybe slightly under, slightly faster market, whereas at least an equal to the 10-year average, right? Where February and January, we're slower. We're slower, right? Bear with me 1 second. We're going to make sure that doesn't happen to you guys anymore. We're gonna turn this into do not disturb, and we can share our screen again. Perfect. No more distractions. Let's take a look at month supply of inventory here. So, similar three-part world that we were living in, right? The pre-pandemic world where month supply of inventory was, at an average of 2 months of supply, given the demand that we had at that time. Demand dramatically increased, supply did not, and so therefore we had a huge decrease in the month's supply of inventory. In many cases, we saw regular months where we were under 1%. In March 21 and 22, we were about at 1 month's supply of inventory. And we have returned back up to a climate where we are 2 months supply of inventory. And and yes, if we expanded the decimals out a little bit more, you would see March of 24 is just slightly under 2 months supply of inventory, and we're just slightly over 2 months supply of inventory, but it's meaningfully the same thing. We are about 2 months supply of inventory. Yes. Now, don't be convinced that because we are back up to a world of 2 months supply of inventory that, wow, this is really a buyer's market now, right? Because it's important to talk about the historical context here. All up until now, I've been only showing you records back to 2018, and usually that's just fine. Here, it is a little bit of recency bias if I don't show you what a true balanced market should look like. And that's at a minimum of 4 months supply of inventory. We have not been in a truly balanced market in over a decade. Since 2012, at least for the month of March, we have not been in a balanced market, right? So, setting those expectations for your clients in terms of pace, uh, let's talk about what a slower market means. For buyers, yes, we are relatively in a slower market, but that just means you have more time to prepare rather than being frantic like many people were in 21 and 22. I say frantic, myself included, by the way, so I get it. Like it was a frantic time. I understand that myself, and I'm sure many of you do as well. Um, Fewer homes in the inventory does mean that gems sell within a month, right? So just because you're seeing things at the median doesn't mean that the quality of all these homes are the same throughout, right? And I'm sure some of you have great stories about how, there's an absolute gem that you listed and it was gone within a day or two, right? That still happens. Overbidding, multiple offers still happens. We're talking about the averages here, right? So keep that in mind that if you have a buying client with very particular needs, don't just wait around because it's a quote unquote slower market than it was a couple years ago, right? Sellers, let's set expectations appropriately. This is still a strong seller's market. Your listings on average are not going to languish on the market, right? Yes, the market will be slower, but with all these other signs that we were looking at from earlier on, this is a good sign for us, right? Listings aren't languishing on the market. They are just slower than the fever dream that we had a couple of years ago. So let's get into a recent topic that we talked about at the Mars Summit, and I know many of you are interested in, and it's around affordability, right? Let's start off simple here and just set context for us, right? PITI, principal interest, taxes, and insurance payments of a median priced home, making some assumptions about percent down, average insurance, and an assumed interest rate based off of the most recent knowledge that we have, we can see a very interesting trend that was happening, right? We saw affordability, the most affordable, back at the very end of the impact of the recession in 2008, 2009, and we've had a pretty linear increase ever since, right? Now, 2020 came around, and because of interest rates being low, there was just the slightest bit of a dip in monthly payments for a median priced home. And then in 2022, that rate increased up, and now we are in a world where the median price home monthly payment is around $2,900 a month. Now, important context to have here, right, is affordability. How much is the average family bringing in, right? Median family income, MFI, here in the Twin Cities by the stats given to us by Housing and Urban Development is 124,000-ish dollars annually, right? Take those ratios from a $380,000 home that we saw earlier over median family income here, and you can see over time our payment to income ratio has also increased. There was a peak of, let's say the higher this number is, the least affordable, the less affordable a home is compared to income. The lower the number is, the more affordable a home is compared to income, right? And you can see we just started to break three times the median family income in order to afford the median price home back in 2020, 2021. Peaked at 3.2 times the median family income. We are now just about three, rounding up to 3.1 times the median family income. Great. What does this mean, right? Yes, it's important to know, but even more importantly is comparing this to other metro areas. And when you look at it in terms of a price to income ratio, a PTI ratio here, Minneapolis St. Paul metro area is actually really impressive. There's only Pittsburgh, St. Louis, Detroit, and Indianapolis of this list of major metro areas that have a more favorable price to income ratio in terms of median sales price to median family income, right? That's really impressive. Now, looking at the far right bar chart that is not in order, you can see that we're kind of middle of the pack of this group of 26 in terms of just median monthly payments. Our PITI, all included, is 12th of this list. And this shows us that it's really important to talk about monthly payments in the context of what our clients can afford. We are lucky here in the setting that we have that our clients on average are relatively high earners compared to median family incomes in other metro areas, right? So let's chat about the new hot thing that people are really concerned about. Property insurance increases up 400% in some condos. Future of homeowners insurance is uncertain. Climate change, is it linked to it? Why does it cost so much for homeowners insurance here in Minnesota? I've been seeing it. You've been seeing it. It is on the minds of everybody. And so we're starting to pay attention to it. I have some interesting visuals here for you that I want you to consider, but keep in mind, we don't necessarily know everything quite yet, right? This is an emerging topic. We're trying to pay attention to it and give you some insight here. So what's happened, right? Our friends over at the Federal Reserve has shown us quite demonstrably here that yes, prior to 2023, premiums for homeowners insurance increased at about a rate of 1.5% year over year, and it peaked at about 11% in the summer of last year. We're now down at around an increase of an annual 9%, so it's not at the true height that it was, but it's still causing some shock for people, right? So, Federal Reserve of Minneapolis as well says, yeah, Minnesota over a 5-year period, 2017 to 2023, has seen a 39% increase on average here in Minnesota for those insurance premiums, right? Intimidating stuff. And it is happening. We're trying to collect data on this right now with some of our friends over in the mortgage industry. And while I don't have that data quite yet, I do have data from North Star MLS, right? And what is some information that we have about North Star MLS? Well, let's use this fun little graphic here to give you context of what I'm talking about. This is a condo, standard condominium, right? With 3 tenants, let's say. Each tenant is paying their HO6, their in-unit homeowners insurance, right? And those insurance premiums are going up. And in addition to that, their HOA's master insurance policy, also a form of homeowners insurance covering the general property and all shared elements of the homeowners association, right? The roof, things like that, the outside. Now, that's paid through HOA payments, right? And wouldn't you know it, North Star MLS has those HOA payments. So we are tracking the increase in master's insurance policy, or we're making the assumption that the majority of any increase in a master's insurance policy of an HOA fee is due to that master's insurance policy. So let's go in with that assumption here and get an understanding with the data that we do have available for you about what's going on. So, taking data out of the MLS to look at the monthly HOA fees at a 12-month rolling average just for previously owned condos here, right? And you can see a fairly linear increase from January of 2020 to January of 2025. And those eagle-eyed will see that there's just a slight increase in slope starting at around the beginning of 23. And when we tease that out, we can see what's happening here. In yellow, you have your year over year change in your HOA. And then in the dotted blue line, you have your year over year change in your median sales price for previously owned condos. And while there was a convergence of these two figures, year over year change, in until about 2022, you started to see a noticeable increase in the HOA fees, right? And a decrease in the rate of growth of the median sales price. So much so that now in late 2024, early 2025, we are starting to see previously owned condos at the median sales price decrease just a bit, but those HOA payments are still higher, i.e., there is more money being spent on the HOA payments and there's less return on the sales price side of things, right? The value of these particular homes are not going up, similar to what we were seeing in the Twin Cities market data overall. So, I have a whole bunch of charts here that I could walk through with you all on, but I think what is even better is showing you in InfoSparks because I want to make sure that you all have the ability to explore the impacts of this uh, with a tool that is available for you. So we're going to be live here playing around in InfoSparks, and we're already logged in through our North Star MLS account, and we're going to click on this separator button here for you, and we're going to turn off all properties, townhouse, condo, and townhouse. And we are just going to look at um, previously owned, single family, and condos, and take a look at the shape of the lines. That's the thing I really want you to pay attention here in this experiment. And I'm going to get rid of the filters, just hide the filters for now. And we're also going to hide this for a minute. And you can see there isn't much going on here because the scale is different, right? Let's hide condos, and you can see a general upwards trend in median sales price. We like that. That's what we want, right? Switch to condos. Flat. Since the early part of 2024, median sales prices for previously owned condos has been relatively flat. Okay, that's one little sign for you, right? Might be a smaller universe of homes. Obviously, they're a little bit more niche than single family homes, right? Let's shift to month supply of inventory. You don't even need to start hiding different series here to understand that for a single family, looks like we've seen a pretty competitive market at about, let's say, 1.5 months supply of inventory, right? And then in condos in red, we started, let's say, mid 2024 with 3 months supply of inventory. And now we're in 4 months supply of inventory. That's a balanced market where we haven't been there for years, right? So let's keep going across days on market, median days on market. Remember, the lower, the faster the market, right? uh, sales, single family homes, we've had about flat, let's say median of, let's say high teens for the past 6 months, and yet a slower and slower previously owned condo market, all until we're at half of all homes in 50 days rather than what we were, let's say early 2024 of 34 days at the median. And we can keep going on into the countables, but the scales obviously are just so different here. We're forced to then look at the series exclusively. So let's take a look at the single family condo market just of closed sales. Yes, there was a big dip, a huge dip, right? We are now kind of at a point of equilibrium since the beginning of 2024. Switch to condos to see if we can find that same equilibrium. A little bit, but it is going down since May of 2024, right? Pending sales is pretty much the same thing, so we won't just repeat ourselves there. Uh, Inventory, right? The more inventory, the less, appealing the homes to a certain degree, right? Just looking at single family, we saw a big increase in inventory, and we've flattened out since what, October-ish of 2024, right? Some of these are market driven. These big shifts market driven, not about the difference between condos and HOAs and insurance, right? Um, but look, condos increasing and hasn't flattened off at all. And then finally here with new listings, right? You can see our reference point here, new listings have gone up a little bit, right? And then flat, pretty stable. Switching to condos now, and more people are trying to sell these condos consistently, not in that same stable way that we were seeing with the single family, right? There's a trend that's happening here. We're showing you the impacts of what's happening. These charts are really just for people who aren't going to be watching the video. They just look at the slides. Similar stories happening, and we're going to be exploring this together. I want to make sure that you all know that we're paying attention to it because we know that you are as well. So with the next 15 minutes or so that I have left, I want to talk about the larger economy, right? So you can understand why all of this is happening and what we might be able to look forward to or prepare for, you know, optimism and pessimism to a certain degree, right? Good news. We have strong employment. We saw the unemployment increase spike in the summer of 2020. The whole nation did, right? But we quickly recovered, and we are now at about 3.5% unemployment here in the Twin Cities. And keep in mind that Twin Cities median family income of about $124,000 means that on average, your clients have resources. There are always exceptions, right? There's a bunch of people that aren't hitting this figure, right? But on average, we do have strong income and revenue sources here in the Twin Cities compared to other metro areas, right? Also, good news, stable cost of living. Yes, 2020 was hard. We did see an increase in our consumer price index. Inflation was going nuts, but we've recovered, right? And we're now down to about 2.5% increase in our inflation, which is about what we want year over year nationwide, right? Now, I got some good, bad news, right? The bad side of it, yes, mortgage rates settled high, right? We are now at about 6.5% interest at a 30-year fixed rate mortgage nationwide. And I say good, bad, and this is kind of like the Midwest, yeah, no, yeah sort of situation, right? Where it is unfortunate that we're not back down to where we were in the pandemic or even pre-pandemic, but it's also good to not have interest rates be that volatile because if they were, the stability of the market would be non-existent. We want something similar to what you're seeing at the far right of your screen here, where we saw a noticeable dip almost touching about 6%, right? And then we rebounded, and now we're decreasing down again. And that sort of seesaw effect will happen over time, right? Mortgage rate projections from Fannie Mae, MBA, and Wells Fargo all say that we are going to see a reasonable, slow, intentional decrease of these 30-year fixed rate mortgages down at around, they say, low 6% towards the end of the year. I'm hoping that's the case, right? And we'll see, right? They were right so far about Q1. Let's see how right they can be throughout the rest of the year, right? More, let's say, bad news, construction costs, right? Construction costs rocketed up uh, at the start of the pandemic, and they kind of flatlined. And those construction costs have stayed there. And that is something that I think a lot of people would look at this chart and say, well, Jackson, it's not going up anymore, so I'm not too worried. Context is everything, right? Let's take a look at the historical version of this chart, right? Big changes have big impacts. Prior to the big jump that we now see in the far right of our corner, historically, residential construction in terms of just the goods themselves, we're talking lumber, we're talking concrete, we're talking the materials, right? Um, that increased at a rate of about 2.5% year over year, right? We shot up really fast. In the context here, the full history of it, you can see it really does look like a dramatic increase compared to what we're seeing just for the past 5 years, right? Now, that rate of increase that I'm highlighting here with the red arrow is at a slower rate of 1.3% year over year. But that jump still is going to have an impact. How long of an impact? If COVID never happened and we never experienced that quick jump, it would take 10 years. The blue line is our alternate reality of no COVID. The orange line is the real world of what happened. And it's going to take until about 2033 for that housing production of goods to be equal. If the rates, in this alternate world would have stayed the same and the rate of 1.3% stays consistent. That's a decade of lost or costly housing production. On top of, mind you, over a decade of lost housing production from the last Great Recession. We're already in a huge shortage. Remember the 2 month supply of inventory thing we were talking about. And it may get worse. We're not going to talk politics. I'm wearing my research hat, not my advocacy hat today, right? But we do need to talk about lumber and imports. Lumber is one of those main goods that we're talking about when we're talking about that last chart. And there is an anticipated 34% tariff on softwood lumber, which will worsen the cost of new construction. And where do we get that lumber from? And if you've been paying attention to the news, you've been hearing the words tariff in Canada, tariff in China, tariff in Mexico, tariff in the EU, which would include Germany, not Sweden and Finland. The EU is a confusing thing. There's a difference between the EU as a country group and then like the EU economic structure. We're not going to get into that, but regardless, without with these tariffs, there will be a decrease in new construction because it will be more costly. And without new construction, housing shortages will remain or get worse. And that is something to just set those expectations with your clients about. On the buyer's side, it's about 50-50, right? Ideal supply and demand mix. The price to income ratio is attainable compared to other metros. You're unlikely to see increase in residential development. So the world of the supply coming in is really dependent on previously owned homes willing to sell in the marketplace. And mortgage rates are high right now, right? They might go down, but what is almost guaranteed to go up is those prices of the home. Buy while you can, if you can, right now, from the buyer's perspective at an economic level. Sellers, the economic correction is over, right? We are now set on a path of new stability in the context of addressing what was going on with the pandemic. And home prices barely dipped. Good news, right? There are future supply limitations. Regardless of the politics of the tariffs or anything like that, there are going to be future supply limitations because of what we were talking about with what already happened with goods increased for construction. Now, the real question for you, given the potential for a more worsening problem, are you as a seller married to your rate, or do your life plans fit your current home? If the answer to either of those is no, then consider buying while you can, right? And if the answer to both of those are yes, enjoy your home, wait out the storm, and you've made the right choice that works for you. Now, that is about all the time that I have. And I know that we have a couple people that are here, but I am going to end the recording side of this and say thank you for watching the whole way through. If you have any questions, please put them in the comments on YouTube. And please feel free to sign up for our next quarterly webinar that is going to be happening in July. Thank you very much for coming, and I will stop screen sharing now. Bye, everybody.